Retirement planning is often treated as a numbers exercise. How much income you can secure, what guarantees you can rely on, and whether it will last. But in practice, the real strength of a retirement plan often comes from something less talked about: flexibility. The ability to adjust spending, adapt to markets, and change how income is drawn over time can dramatically improve a plan's resilience. Today, we're joined by Keith Sheehan of W&M Wealth and Investment Management, who will help us explore what flexibility actually means in retirement, who it matters for, and what happens during periods of market stress. Ultimately, why adaptability, not rigidity, is so often the key to sustaining income over the long term.
Delighted to be here, and thanks for the invite.
No worries. So Keith, when we talk about flexibility in retirement spending, what does that actually mean in practice? And why is this so important when looking at retirement planning?
So I think it's about knowing your numbers and understanding how much you're actually spending or likely to spend. And I think actually not enough people do the work that's important to understand their essentials expenditure, discretionary expenditure, and also their luxury expenditure that they think for, holidays. I had one client, for example, he wanted to invite 100 people to his 60th birthday. But if we had a stock market crash and it dropped by 50%, I always joked with him, which 50 people would he no longer invite? So I think that's important. Now, the way to have got around that problem around the party is actually to have liquidity and actually have money available if we need that. And the way to create liquidity is to have money sitting in cash or fixed income or other sources, or even in terms of state pension could be classified as a source of liquidity for people to pay their essential expenditure. So I think that's really important when you're relying for most of your discretionary from a growth type investment portfolio, whether that's in pensions or general investment accounts, ISAs, etc.
Okay, so really following on from that, who does this kind of flexibility tend to be most relevant for, and how do they achieve it?
So I think the majority of people that this is relevant for will be people who have high discretionary expenditure, want to be able to maintain their expenditure in the medium to long term, but actually have the ability to be able to cut that back if they need to. So somebody, for example, who has high essential expenditure probably shouldn't be investing into growth assets because they continue to need to spend that money, keep the lights on, basically, even when a stock market crash happens, which means that if they are invested in growth assets, they effectively need to draw significant amounts of money out at completely the wrong time. And that has a detrimental impact on the long-term nature of the plan.
And you touched on it slightly there, but how does drawing from growth assets change the conversation compared to relying on fixed income or guaranteed income?
Yeah, it comes down to the variability of the value. So we can invest in the best companies in the world, but sometimes people will need to sell those shares because they need to pay bills, which means that sometimes when you have a market crash, even the best companies will find that their share price goes down. So if you're reliant on an income, or if you're reliant on using the capital to supplement all your expenditure, then actually when the market drops, again, I like using the example of 50% because that's something clients can work out in their head, is if, for example, you had a bill for a holiday which was £20,000, suddenly your holiday is £10,000 that you can afford, or you pay the £20,000, but it means that you've got less money when the market recovers. The key thing here is that actually we normally have liquidity for clients of around 3 years plus, which means that they know that they've got the access to cash or to some form of investment that won't have that same volatility in price.
And what happens to spending strategies during periods of market stress when flexibility has been designed effectively into the plan?
Yeah, well, I always talk to clients around, and it's a horrible way to describe it, but catastrophe planning. When something happens and it's pretty bad, that could be ill health, death within the kind of the planning, but also very much around market risk. Actually, having had those conversations beforehand, what would we do? Where would we get liquidity? Where do we, what do we cut spending? All of those things I think are really important, such that when I've had clients and we've gone through those experiences, they are taking the highest level of risk that they can possibly take without breaking the plan. And by breaking the plan, I mean them having to take money out of growth assets at completely the wrong time.
Why does the ability to adjust spending matter for long-term sustainability of a retirement plan?
I think it's critical. The simple fact, if you spend too much money now, you're not going to have money in the future. And the point around retirement planning is that unfortunately we don't know when we're going to die. Or actually, maybe that's a fortunate thing that we don't know when we're going to die. So the idea of having that last check bounce is really difficult. Instead, it's around maintaining confidence that you've got enough money to live your life well. What that does mean is that in times of periods of market downturns, actually taking large amounts of money to maintain discretionary expenditure isn't a really good idea. So instead, you have either you can maintain your discretionary expenditure, but you use your emergency cash or liquidity, or you sell assets that are less volatile, such as fixed income, or you cut your expenditure. And that's the discretionary expenditure that you can, you have the flexibility to be able to change it. Flexibility is important.
And finally, when thinking about integrating flexibility into a retirement income strategy, what tends to matter most in making it work well over time?
Well, I tend to use use cash flow modeling with the clients, because then you just put the standard variables in, and it's really important. You get to know what their essential expenditure is, their discretionary expenditure, and even luxury expenditures that they might want to do, say a 60th birthday, a 75th birthday, those elements. How do we make sure that they're available, the money to be able to afford those is available? Or what things are we willing to change to make sure that the plan sticks in place? And I think one of the most important criteria is around the assumptions we make on growth as well. Actually, what level of growth are we prepared to accept? Because growth comes with risk, and the volatility risk I'm talking about here, which is actually, can we survive through those periods where there's a market downturn? If the market went down for 3 years, how do we make sure that we've got sufficient money to survive that? So critically, I think cash flow modeling, essential, and discretionary expenditure, what you're prepared to keep going and get rid of. And also, I think the whole idea of pulling that together with what's actual level of risk that you're prepared to invest at, and the investment returns you anticipate are really important.
Thank you very much for your time today, Keith. I appreciate that a lot. And to find out more about retirement planning, please do get in touch.